A company that has existed for over 100 years just had its worst day in the stock market since 1961. Not because of a scandal. Not because of fraud. Not because the business collapsed overnight. Because of artificial intelligence. And the way it happened is so specific, and so revealing about where the global economy is heading, that it is worth understanding in detail. Because what happened to IBM today is not just a story about one company. It is a story about what AI is doing to the entire technology industry, and why it matters for your money even if you have never owned a single share of IBM in your life. Let us start with the facts. IBM is one of the oldest and most established technology companies in the world. It has been operating for over a century. Today, its stock fell approximately 25% in a single trading session. The stock is on pace for its worst day ever, dating back to 1961. The previous worst day was October 1987, Black Monday, when shares fell 23% during the worst day in the overall stock market's history. What caused this? IBM released preliminary second quarter results ahead of its scheduled earnings call. Revenue landed at $17.2 billion, against analyst expectations of $17.86 billion. That is a gap of approximately $660 million. But the number is not what sent the stock down 25%. The explanation for the miss is what did it. In the final weeks of June, IBM's clients shifted their quarterly capital spending towards servers, storage, and memory purchases to secure supply-constrained infrastructure ahead of expected price increases. The money came out of their software and consulting budgets. Read that again. Because it is the key to understanding everything. IBM's customers did not stop spending money. They shifted where they were spending it. They took money out of their software budgets and moved it into hardware, specifically into the servers and memory chips that artificial intelligence systems require to function. The AI memory shortage started eating software budgets. Companies rushed to buy servers and memory chips before prices climbed even further, and they paid for it by pausing the software orders IBM was counting on. This is the mechanism. This is how a 25% single-day decline happens at one of the oldest technology companies on the planet. But to understand why this matters beyond IBM, you need to understand what it reveals about the broader economics of the AI era. For the past several years, the story of artificial intelligence in financial markets has been relatively simple. Companies that make the hardware AI needs, the chips, the servers, the data centers, have done extraordinarily well. The logic was straightforward. AI requires hardware. Hardware requires companies to make it. Therefore, hardware companies benefit. What the IBM situation reveals is that this story has a second chapter that most people have not been paying attention to. The budget that companies are spending on AI hardware has to come from somewhere. Corporate budgets are not unlimited. When a company decides to spend more on servers and memory chips to build out its AI infrastructure, it has to spend less on something else. And what it is spending less on, as IBM's results make painfully clear, is software and consulting services. Enterprise IT budgets are finite. When memory and storage prices are rising fast, buyers accelerate hardware purchases to beat the increases, and the money comes out of discretionary software spend. IBM was not alone. Software stocks fell everywhere. Workday dropped 10%. Salesforce lost 6%. Microsoft and Oracle both slipped. The IBM decline sent a signal through the entire software sector because the logic applies broadly. There is a second element that makes the IBM story even more significant. IBM also said its customers were distracted by the emergence of a significant new AI capability that raised cybersecurity concerns. That paused several large deals that IBM had anticipated closing by the end of the quarter. Deals that were expected to close did not close because companies needed time to assess what the new AI development meant for their existing systems. IBM found itself on the wrong side of both forces simultaneously. Budget reallocation toward AI hardware, and deal delays caused by AI-related uncertainty. The combination produced a miss large enough to trigger a historic market reaction. What does this mean for ordinary people? The first thing it means is that the AI transition is more broadly disruptive than most public conversation suggests. For every winner in the AI transition, there are companies being pressured. The money flowing toward AI hardware is flowing from somewhere. Understanding where it is coming from is as important as understanding where it is going. The second thing it means is that the technology sector, which has driven stock market returns for the past decade, is entering a period of significant internal disruption. Companies that seemed stable are discovering that the assumptions their businesses were built on are being challenged faster than they anticipated. The third thing it means is more fundamental. For decades, the technology industry operated on the assumption that software is the high-value, recurring revenue layer of the technology stack. Hardware was considered the commodity. Software was the durable, defensible business. The IBM situation challenges this assumption. When hardware becomes scarce, it becomes the constraint that determines everything else. And when hardware is the constraint, the companies that control it capture the value, while software companies compete for a budget that has already been spent on something else. The enterprise software industry has spent 15 years telling investors that its revenue is non-discretionary. IBM's results suggest that the CFO gets to decide what non-discretionary means when the server order is due this week. IBM itself is not standing still. The company has been investing in artificial intelligence capabilities, quantum computing, and hybrid cloud infrastructure. The irony of today's situation is that IBM built products designed to serve the AI era and found them crowded out by the spending the AI era is generating in other parts of the technology stack. The full IBM earnings report is scheduled for July 22. That report will tell us whether the pattern is temporary or whether it represents a more sustained shift in how corporate technology budgets are being allocated. What is already clear is that today has made something visible that was previously only visible to people paying very close attention. The AI transition is not just creating winners. It is disrupting existing business models in ways that are happening faster than most companies and most investors anticipated. The stickman watching the AI boom from the outside might have assumed the winners were obvious. What IBM's results suggest is that the disruption is more complex than that. Even companies actively investing in AI can find themselves on the wrong side of the spending patterns the AI transition is generating. Understanding that complexity is useful for anyone thinking about the technology companies in their investment portfolio, or simply about the direction in which the economy is heading. Quick reminder: everything in this video is for educational purposes only and does not constitute financial advice. See you in the next one.